All right, this is Ubaid on behalf of We Electronics, and in this video, we're going to talk about banking innovations. Now, most of the banking innovations happened during the Depression, during the Great Recession, during inflation, so on and so forth. Okay, where borrowers, would technically borrow money, for example, and use their policy loan, insurance policy loan, for example, as a collateral, And when this happened, the banks, would lend the money, However, the borrowers would sell or lend this money to somebody else, acting as a private lender and earn more in interest, As a result of which, you basically had banking innovations, banking innovations such as, adjustable rate mortgages, or variable rate mortgages, so during the inflation, or during depression or recession, whatever you want to call it, what ended up happening was, people would technically borrow, money, at a fixed rate. Now this was a lot of risk for the banks, as a result of which banks who borrow short and lend long ended up earning less than what they were paying these borrowers. So technically speaking, let's say during an inflation, if the interest rates went down, and let's say the borrowers who were paying mortgages, where, let's say, paying less than the interest rates, that the depositors collected from the bank. What ended up happening was, the banks had more money flowing out of their reserves than money coming into their reserves. All right, as a result of which, the banks were not making as much profit. In many cases, they were losing money. So what ended up happening was an innovation when it came to your interest rates. The banks came up with something called adjustable rate mortgage or adjustable rate loans. And what this meant was that the risk was transferred to the borrower rather than the lender, the bank. So you have adjustable rate mortgage or loan. All right, so when we talk about adjustable rate, this is an adjustable rate based on things like inflation. All right, so we talked about things like COLA rider, in the past couple of videos, where, rates, they are adjusted based on inflation. Prices are adjusted based on inflation. So when it comes to adjustable rate mortgage loan, for example, the banks could basically bump the interest rates up, when you had inflation to counter the effects of inflation, right? Because during an inflation, the purchasing power goes down, as a result of which people are spending less. People and businesses are spending less in general. And when it comes to interest rates, what ends up happening with the interest rates, as we learn from our monetary policies, in economics, during an inflation, the interest rates go up. All right, so when the interest rates go up, the people who deposit money rather than spend money are earning more in interest. As a result of which, the banks who are receiving interest from these mortgage loans, fixed rate mortgage loans, are not receiving as much interest as they're paying, in terms of your savings account, for example. So this has to do with adjustable rate mortgage loan. So what the banks did, they came up with an innovative idea. And what was the idea? The idea was to adjust the rate based on things like inflation, things like recession, things like current events, okay, if there was a major catastrophic current event in the country, which would impact the banks as well, okay, the banks would adjust their interest rates likewise. All right, so this has to do with adjustable rate mortgage loan. So adjusting interest rates, and most importantly, transferring the risk. Transferring the risk, in this case, to the borrower. Okay, because when you have fixed rate mortgage loans, okay, who's going to profit from this fixed rate mortgage loan? The borrower. Okay, in the case of an inflation, they will end up paying less and they will earn more from their savings account. So the person who's borrowing the mortgage, or the person who's borrowing a loan, whether it's a car loan, whether it's a line of credit, whether it's a personal loan, is paying less to the bank who's making less. Okay, and in return, when there is an inflation, and let's say the Federal Reserve decides to bump the interest rates up, the government decides to bump the interest rates up as part of their monetary or fiscal policies, okay, what's going to end up happening is the banks will pay more in interest for every penny you have in your savings account. All right, so fixed rate mortgage is for the borrower. Adjustable rate mortgage is for the lender. Okay, because now the banks are transferring this risk to the borrower. Okay, when they can adjust the rate, okay, they don't have to lose money. Okay, they can adjust the mortgage rates. They can adjust the rates for your car loan. They can adjust the rates for your personal loan. So if the rate is 5%, and let's say you have an inflation setting in, they can bump the rates up to 8%, for example. So you end up paying more, 8% when it comes to your mortgage, for example, or a personal loan or line of credit. Okay, so that will be it for this video. On behalf of Electronics, this is Ubaid. Have yourself a great day.